All right, good afternoon or possibly good morning to everybody, and welcome and thank you for logging on to our webinar today. Well, we're going to talk about how to create a lending program with your IRA. We're lucky to have a guest on with us today who's going to come on in just a few minutes and talk to you specifically about doing some private lending with your IRA account. Obviously, we teach a lot of webinars and seminars that are on our YouTube page. I encourage people to go there. We talk a lot about the basics of self-directed IRAs or doing lending within an IRA or buying real estate. And occasionally we do have, and like as we'd have today, a guest on to talk to us something very specifically in regards to lending within your IRA and maybe even taking some of what you learned today and applying it even outside of an IRA. But like I said, we'll get to that here in just a few moments. For those of you who are listening live, I would encourage you, if you have questions either from myself. My name is Scott Maurer. I'm the Director of Business Development for Advance IRA. So if you have questions for me or if you have questions for our guest when he comes on later, please type those into the chat box on your screen. Due to the number of people that we have on for webinars, we can't take any live questions as far as unmuting phones and whatnot. So just get your questions typed into the chat box and we'll make sure that we get those covered and answered. If you're listening to the recorded version, my contact information will be at the end of this webinar. You can write that down and get in touch with me, whether it's a question for myself or for our guest speaker today. I just want to make everyone aware of some upcoming events that we have, the webinars and seminars that we have coming up here at Advance IRA. We have another great webinar scheduled for next Tuesday, January 31st. We'll talk about how a health savings account works. It's going to be from noon to 1. Great new webinar that we have that we'll be premiering that day. We have some live luncheon seminars where we're talking about private lending in your IRA account. So we'll touch a little bit on that today with an IRA, but we'll go into more detail on those live seminars either in our Tampa or Atlanta office coming up in the early part of February. We also have another webinar on Valentine's Day, and we have a live networking event up in Atlanta at the Five Seasons Brewery. We'd love to have people come out to. We call it Brewing Success, where we do free food, free beer. We usually bring in a great guest speaker. So we have that next event scheduled for Atlanta on February 21st. To register for any of these events, please just go to our website at advanceira.com and click on the Events tab, and you can get registered for those upcoming events. Now, before we get into the meat of our webinar today, I always like to give our disclaimer that at Advance IRA, we do not give any legal, tax, or investment advice. So when it comes time to making decisions on the best strategy or the best investment, what's the best thing for you to do with your IRA account, you would need to look to other parties for that information. We can always give you guidance and give you some referrals to some attorneys or accountants or maybe some advisors to help you make those decisions. But at Advance, our job is to act as a record keeper and simply provide that service for any IRA clients. Especially when we get into talk about today, we have a guest speaker on, what he's going to talk to you about. If you have questions in regards to that, obviously you would look to him to get those questions answered. A question just popped up. Will this webinar be available offline later? Yes, this webinar should show up on our YouTube page within the next few days. So if you can't watch the whole thing today or get cuts out at all, you can certainly go to our YouTube page and make sure to follow up there and watch the webinar. For those of you who might be new to Advance and new to these webinars, just a quick background on our company. Our company name is Advance IRA. We are a self-directed IRA administrator, meaning that the only thing that we do at Advance, we don't sell mutual funds, we don't sell stocks and bonds. We simply provide a service of doing record keeping and administration into alternative investments. People wanting to use their IRA to buy real estate, using their IRA to buy private stock or private placements, or as we're going to talk about today, maybe doing private loans from your IRA account, having your IRA act in a position as a bank. So a lot of different things you can do with an IRA, and we specialize in simply holding those assets and doing the administration that comes along with it. We have a dedication to customer service. We have each client gets assigned to an account manager, one person who can help them throughout anything they need regarding their account. So again, our primary focus is on customer service and then holding these alternative assets. And we also like to provide a lot of quality education. That's why we have webinars like the one you're listening to today, and we like bringing in guest speakers as well on these webinars to hopefully really expand the breadth of knowledge for all of our clients. Again, most of you on this webinar already know about self-directed IRAs, but for those of you who are newer, why haven't you heard about this in the past? A very simple reason is that most retirement accounts are held with banks and brokerage firms who limit you to buying and investing in those products that they sell. So they're not going to tell you that you can invest in real estate or that you can invest in private loans through your IRA account, because it doesn't serve their purposes for having you invest with them. If you found out, their fear, and probably many of you have already done this, their fear is once you find out you can invest in alternative assets, you're going to take your money and leave that institution and go find a self-directed administrator like Advana to put those investment dollars to use. So the reason why people don't know about it is it's certainly not going to be advertised to them by their bank, by their current brokerage firm. So it takes, as a lot of you have already done, taking the initiative on yourself, learn a little bit about self-directed, do some Google searching, watch webinars like the one you're we're doing today. So the rules, IRS rules, allow for a very broad range of investment. It's up to each custodian to decide what they're going to hold. And since Advana, we don't sell any products, we will hold anything that's allowable under the IRS guidelines. So we talk about private loans. So again, you can invest in real estate, private stock, gold, silver, so many different things you can invest in with your IRA. But we're going to stick specifically today to talking about private lending and your IRA acting as a bank. And some of the reasons why do people invest in this type of asset. I think for a lot of clients that do private lending with their IRA, it's enticing to them that they get to act as a bank and determine the terms. So if you're going to go to a bank today to get a loan, that bank or that lender is going to tell you exactly what terms they're willing to lend money to you. Well, if it's your IRA account and your IRA is acting as the bank, you're getting to set and determine those particular terms, and therefore it can set the rate at which your IRA is going to grow. For others, investing in private lending is less cumbersome, and it's a low maintenance asset. If you're making sure simply that you get a monthly interest payment in or a monthly mortgage payment back in, rather than making sure you got your monthly rents from a piece of real estate, and then also keeping up with all the maintenance items for a piece of real estate. And therefore, it can have some less liability as well. But for private lending, it's low maintenance. It can be easier to do over the long haul. And again, you're going to get to set those terms at which your IRA is essentially growing. And along with that, you're deciding what type of lending you're going to do. There's certainly traditional mortgages where your IRA lends money to someone backed by a piece of collateral, typically a residential or commercial piece of real estate with, terms. Basically, the payments come back over a period of years. Interest and principal may or not be included. But you can also invest in short-term transactional funding or kind of bridge loans if someone needs a 30-day loan to cover them on a deal and receive some good interest and points on that. You can lend money unsecured, and I'm going to talk about that here again in just a moment, but it is not required that you have collateral for a loan. The IRS does not require you to have a collateralized loan in your IRA. But that being said, probably not a bad idea to have some collateral. And so again, that's an individual decision. We've seen people structure their IRA loans as joint ventures with other individuals and doing some equity participation. And you can also secure your loan with farm equipment, livestock, other types of assets as well. And again, getting back to setting the terms, if your IRA is going to lend to a third party, your IRA or you as the IRA owner can decide what those terms are going to look like. How much am I going to lend? What's the interest rate going to be? What's the length of term? When does the loan need to be satisfied by? So all those terms that go into making a loan or making a mortgage loan from your IRA account are under your control and working with your borrower. And again, I think that's something that's very enticing to individuals looking to do private lending from their IRA account, is very simply that they have much more control over that, and they're being able to set those terms. What's the down payment going to be? What's the collateral? Et cetera. All of those terms that go into that are yours to decide. Now, again, just one note on unsecured notes, something just to consider. Again, it's not required that you have collateral if you're lending money from your IRA to some third party. Our recommendation, or not to say recommendation, but typically we see people that have collateral as a piece of real estate, commercial, residential, collateralizing their loan, but it's not required. You could do something, an unsecured note, where you fill out a piece of paper or a loan, basically a one-page note that somebody signs promising to pay to your IRA account. That's legal to do. Again, it's just going to be riskier. So typically you would see the interest rate on that type of unsecured lending be a little bit higher, and you definitely want to make sure that you know who your borrower is. If that person defaults on the loan, your only real recourse is probably going to be to take them to court to enforce the note. If you have collateral, if you have a piece of real estate behind that note, there's a foreclosure, there's a legal foreclosure process to go through to get payment back or to at least to seize that particular property. And because there's no collateral, if you're going to do an unsecured note through an IRA account with us, we require that original note to be in our possession before we will release funds from your account. If you're lending money on a collateralized basis and you're going through a title company or an attorney's office to handle that deal, that attorney's office, that title company is going to be required to make sure that the documents all get executed before they release funds. So because the title company and attorney are involved, we are comfortable wiring the money or sending the money to that institution and then letting them disperse once the documents have been signed. But in the case of an unsecured note, there is typically no third party, and therefore we ask for the original note in our possession before we will actually fund. So that's, again, a couple of just notes on IRAs and your IRA investing in private lending. Again, we have a live seminar both in our Tampa and Atlanta office coming up on February 10th, where we'll get into much more detail about unsecured notes, secured notes, and self-directed IRAs as well. But at this time, I want to bring in our guest speaker today. It's Kevin Pombuff with StreetLender.com. Kevin is going to come on and talk about some how to create your lending program within an IRA account, or possibly, again, taking some of what you learned today and applying it to non-IRAs as well. But Kevin is the managing director of StreetLender.com. It's a nationwide direct private money lender, servicer, and consulting firm. Kevin has spent his 24-year career in mortgage banking focused on commercial and residential lending and has closed hundreds of real estate transactions. Kevin is an investor himself, and he's held equity and management positions in multifamily projects, mobile home parks, long-term rentals, and single-family rehab flip transactions. So at this time, Kevin, are you there?
I'm here, Scott. Can you hear me all right?
Great, Kevin. I am, yeah. And before I turn it over to Kevin, I'm going to let Kevin go through the slides and give you some great information. I would encourage everyone who's listening live to this webinar today, if you have questions as they come up, again, for Kevin or even for myself, type those into your chat box on your screen. Kevin, I will monitor those. So I may interrupt every now and then to ask you one of those questions. But for now, why don't you go ahead and take it over.
Scott, well, thank you so much. And hello, everyone. And thank you again, Scott, for a really warm welcome and introduction. And also to Advance IRA for inviting me on today to speak about something I'm very passionate about, which is private lending on real estate and specifically within your self-directed IRA. So one thing is really interesting is that very few people know about self-directed IRAs, and even fewer people know that they can even do private lending within their self-directed IRA. So I think the beauty of this is that you can be as involved as you'd like and actively participate in private lending, or even take a passive approach, like Scott was mentioning a minute ago, where you can use the same principles here, but have someone else or another company handle the entire lending process for you. So today we're going to be talking about how to create your lending program, and I'll be going through the slides today to discuss that. And so whether you choose to be active or a passive approach in private lending, the things that we talk about today will help you prepare to successfully improve your returns and allow you to take control of your retirement. So I'm really honored that you're here. The next few minutes, say 40 minutes or so, I'm going to give you the very best content and useful tips that I've learned and applied over the last 20 plus years in real estate lending. So I'll be talking about how to create your private lending program. And ultimately, my goal today really is to get you to think like a bank, okay? To use the principles like bankers do in order to transfer away the risk while securing a high return. And because you're making private money loans on real estate, you are the bank. So that's ultimately my goal today. So, and the general theme is, how do we define and create solid guidelines in order to protect your self-directed IRA? And in this presentation, I'm going to cover the what's, the whys, the how-tos, and I'll also be giving you some best practices and even walk through a sample loan program. And then if we have time, we'll take a look at a test case. So, and just make sure you stay to the end because I can hear you, Scott. How about now?
Okay, Kevin, there you go. I got you now. Okay, great. Kevin, yeah, if you wanted to start back over, I apologize for what had happened, and how everybody's still logged back in. It looks like most everybody did, so why don't you go ahead and then continue on?
Sure. So I'll just back up a tad here and talk about the goal, which really today is to get you to think like a bank and to use the principles as bankers do in order to transfer away risk while securing a high return. And because at the end of the day, when you're making a private money loan on real estate, you are the bank. So really the general theme is how can we define and create solid guidelines in order to protect our self-directed IRA. And today I'm going to cover the what's, the whys, the how-tos, and talking about some best practices along with walking through a sample loan program so you can see exactly what that looks like. And then if we've got some time at the end there to walk through also a test case. So I think that's kind of where we left off earlier, but just make sure you hang on till the end. I'm going to give you an opportunity to reach out and get a copy of our underwriting checklist that we use, and also provide an opportunity to provide to you your lending program review, just to make sure that there's no gaps in your process or any hidden risks that you might be taking there. So, and if you got any questions, I'd be happy to answer after the webinar. So do you know when really is the best time, and really the only time to worry about a loan? And well, that's really actually it's before it's actually made, before actually making that loan. And like pilots they have a saying you may have heard before, that I'd rather be on the ground wishing that I was in the air than being in the air wishing I was on the ground. And it's so true, because it's a little too late to check your wing flaps at about 15,000 feet. And really the same holds true in making a real estate loan. And that's exactly what we're doing here, is checking our wing flaps before we take off. So today I'll talk about some of the basics. Some of the folks that are on the call may be a little more sophisticated and more advanced and may have some more knowledge, but I'm going to cover a lot of basics, but then also dive a little deeper on some advanced topics and strategies. But really, what is lending a program? What is it all about? Well, a lending program is a specific set of guidelines and parameters to which you're willing to lend your self-directed IRA to a borrower, a real estate investor in this case, in a real estate transaction. And most of us probably are familiar with the term fix and flip or rehab project transaction. There are other scenarios, real estate scenarios, long-term holds, which we may touch on, but the distinction here is that these are your guidelines. These are your risk tolerances when you're looking at making a private money loan. And you're the lender, so you make the guidelines, like Scott had mentioned earlier. So you might be thinking, okay, well, what's the difference between, say, a lending program versus underwriting? Well, you'll see a little more specifically on the next slide, but simply put, that underwriting is really more the process and reviewing, and the lending program is really the guidelines, the framework to which the underwriting process works. And why is it important? Well, the biggest reason is that it's really to protect your asset. And by not establishing some guidelines, we're here to really make sure that those guidelines are established and then followed, because it secures and protects your money in your IRA. So another reason it gives you guidelines to follow and a path to keep you on track, because a lot of times what will happen is the lending guidelines and loan program will give you really a way to say no. And when the program or the loan option is just outside of the project outside of the guidelines, you might be swayed by the pressure that's given to you by a borrower or by the interest that other people have in the project. Maybe the seller or say the real estate agent or who knows. But you want to make sure that you have a solid path to make sure you're protected. And remember, banks are in the business of making loans and very strict guidelines and set guidelines for good reason. And as a best practice, you should too. So how do we actually apply it? How do we take this loan program and when do we put it into practice? Well, you'll see on the next slide, but your lending program goes into practice even before you say the first word to a potential borrower. So I say this in tongue-in-cheek, but what I mean by that is that your loan program should already be ingrained in the back of your mind. So when you're talking to a borrower, you're already going through, okay, how is this project that someone's offering me, how is it lining up with my lending program? Am I willing to take this risk? Is this a location I'm looking to lend in? So let's move here to the next slide and really show you how this works. So as you see here, I've laid out here the bottom here. The boxes are actually the lending process timeline from the very moment you meet and source and pre-qualify a potential borrower through the underwriting or final review, through closing, and then all the way down to the property being completed, being marketed, sold, and then eventually refunded back to your IRA. So, and the blue boxes indicate that the underwriting period, that's the time frame in which you are applying your loan program through an underwriting process, the underwriting period, okay? That includes, the scope of work, the borrower, talking about their credit history, their experience, getting the appraisal, getting the application in, reviewing the title work, making sure that that the closing docs are prepared properly. So in this process is where you would apply your loan program, right there in the first three sections of the process. So let's talk a little about best practices, and really the central focus should be on really the return of capital, okay, and the return of capital, and then looking to obtain your return on capital. So, and what we mean by that really is making sure that your position, the loan you're making, is secured. And in this case, I know Scott had mentioned a while earlier in the introduction that, as a private money lender, you could do loans on unsecured. But in this scenario and in my world, we're talking about all secured lending, which is having a promissory note and a mortgage on a property. But let's talk about some best practices here. So the loan program really is really a framework that ultimately leads to a strong underwriting guidelines. And we'll talk about on the next slide a sample loan program, one where you can take and change and modify to fit your risk tolerances. And the next one down is the goal is to really mitigate the risk, is to really transfer the risk from the lender, the banker, your self-directed IRA, to the borrower. And that's a fundamental practices of how banks work, okay? They are looking at every possibility to transfer or mitigate that risk for the bank. And that means that, how can we do that? If we have higher risks in some area of a loan program, how can we mitigate that by taking or reducing our risk in other areas of the loan, or security, or collateralization? So what do? How do we modify other parts of our loan program and our underwriting criteria to transfer away that risk? And evaluating our exposure. So one way by doing that is to cross-collateralize. So we'll talk about that in a minute, but how, if we've got a borrower that has maybe a little lesser credit score, can we look at maybe cross-collateralizing some other property they might have to secure that during the loan period that we're protected and you're protected in your self-directed IRA? The other best practice would be to use trusted third parties. And as Scott had mentioned earlier, the closing attorneys, escrow folks that will be, depending on what state you're in, it's either going to be an attorney closing your real estate transaction, or it could be a title company. and also your appraisers. Again, you're the lender, so you are the one who drives what appraiser you use. So it's a very trusted third party that you want to lean on to make sure that you're protected in every area. Validate and quality control. Well, you know the old saying, you trust but verify, right? But we always want to obviously trust what people say, but also verify to make sure that what's being presented and offered, especially when you know, underwriting or using a loan program to determine an approval or not, you want to verify to make sure the information is correct. Also looking at the accuracy of the title and the appraisal and the credit report that's being pulled, the reserves, the employment. So all these are best practices to do in the process. I want to kind of stop here and talk really a moment about property types, which property types being manufactured homes or unique layouts or just unusual type properties, along with duplexes or multi-family type properties, including a duplex, a triplex, or a fourplex or more. A couple of things we got to think about is your exit strategy, all right? So anytime you're looking to make a loan, one of the first things you want to understand is really what is the intent? What is the intent of the borrower? What's their exit strategy? Are they looking to borrow the money to buy the property, do the rehab, and then flip it? Or are we looking at it as more of a long-term hold? Are you looking to purchase it, maybe do some light rehab, and then hold it? Because that really drives the exit strategy and how you're looking at approving, whether you're going to approve this loan or not. And the reason why we want to talk about property types so much is really critical is because the property types can ultimately drive the exit strategy. So let me give you an example. So let's say a borrower came to you and said, hey, I found this great property. It's a duplex, and it's a great deal. Okay, yeah, it might be great, but if your exit strategy is to fix and flip a duplex, think about it. Most of the retail market, you know, the John Q. public out there, is not looking to buy a duplex to live in it, bring their 2 kids in. It's just not going to happen. So you want to make sure that you're comfortable with and your risk strategy is okay with holding that property for longer periods of time, because the only exit strategy, well, I would say only, mostly the largest exit strategy for a duplex would be to refinance that property, like refinancing your loan into a traditional bank loan. So the question is, how strong is the borrower to go to a traditional bank and get a refinancing option to cash you out and refund your IRA loan? So, and that also goes along with property types that are unusual, manufactured homes, non-traditional layouts, unique layouts, A-frames, those kinds of things. Because, again, same concept. You have a borrower that wants to buy an A-frame on the beach somewhere. Very unlikely that's going to be a property that a retail market buyer is going to want to buy, which means longer time for the property to sit on the market, which creates greater risk for you and your self-directed IRA. So it's really critical that property is ultimately looked at very closely, because it's the security of your loan. So this next few here talk about really avoiding deal emotions and being able to say no. And the loan program gives you that ability to stay, or at least try to stay, out of the emotional piece of the lending process. When you have guidelines, it's in black and white. Here it is. So remember that no is your friend, okay? So there are more borrowers, real estate investors out there than you could find, than you can imagine. So finding a borrower to make a loan is not the problem. So make sure you can stick closer to your lending guidelines, okay? And also, it is also okay to get creative. So, as we talked about a minute ago, you know, even though a project doesn't necessarily fit exactly in the box, that's what exceptions are for. You know, as long as your risk tolerance is okay with what the project looks like, and you can mitigate the risk by going outside your guidelines or outside your loan program, that's okay too. There's a lot of ways that you can actually look into still protecting your asset. So let's
Hey,
talk
Kevin,
about,
Kevin, I'm going to interject you. So we had a question pop up. I want to make sure we get it addressed. I think it's more one that I would answer, but the question was, can the owner borrow from his IRA and use the money to purchase real estate? And the answer to that question is no, but there's certainly different ways you can I think, accomplish what you're looking to do. It is prohibited for an IRA owner to personally borrow from their own IRA for any purpose, whether it's real estate or not. But it is possible, and this might be a different webinar for this person to attend, but it's you can use your IRA funds and simply have the IRA directly buy the real estate in the name of the IRA account. So you wouldn't be you borrowing it from your IRA. It would be your IRA possibly going to purchase that actual real estate. Your IRA can only lend to people who are not considered disqualified, which disqualified persons are yourself, your spouse, and some family members. So just wanted to get that question addressed, Kevin, but go ahead, keep on going.
Yeah, good, Scott. Yeah, that was a question directed more towards you, but thanks for asking or answering that. So let's talk about some sample. Here's a sample loan program that you could use and modify how you wish, but here's some ideas that would help guide you if you're new to the business or actually have made loans before. Here's some things to look at, to consider in your process of approving a loan. So there's a lot of things that you look at when you're trying to determine whether or not you're ready to make a loan, like any traditional bank, okay? They've got programs, they've got guidelines, and the first thing you want to consider, especially in a fix and flip environment, that's typically a short-term transaction. It's usually as short as probably 3 months, maybe shorter, but it really could be as long as you wish. But typically you're looking at anywhere from, say, 3 months on up to, say, 18 months. And that also is a driver from the complexity of the project. So if you got a small, $120,000 or $80,000 or $150,000 property that needs paint and carpet, it can turn over pretty quickly and a real estate investor can get it done, then you're not going to need 18 months. It also is the driver. Part of the driver to that fact is how's the marketing time. Properties that sell in Orlando sell much differently than houses in Omaha, Nebraska. So there's a couple different drivers on the term. And one thing to consider is and as a best practice, is to start it as those terms being short as possible. So, for example, in our program, we typically would do a 6-month term with 3-month extensions. That way, your money is not at risk as long as, say, just a straight-up 24-month deal, okay? So the other thing to consider is that if you're doing extensions, you could also have a fee to extend that loan term. Going down to the next item within the loan program is the lien position. You would either preferably be in a first position secured, which means first position, you are the first lender or creditor to get paid in case the worst case scenario happens, foreclosure, or when the property gets sold. Being in second position obviously is done. However, you want to make sure that you're even in second position, the combined loan to value or compared to the value of the property, there's still equity, and being in second position, you still have a good chance of getting paid off. The other thing to consider too is a loan to value, and you'll see this as in the real estate rehab world as what we call ARV, which is after repair value, and it also could be described as loan to value or LTV. Okay, and traditionally, what you'll see is in our best practices is 70% of the ARV or LTV. So the max that you would consider loaning is 70% of the value of the property, or after repair value of the property. And the biggest reason is to put you in a position of protection and security. So, for example, to make the numbers easy, let's say the property after it's completed and repaired, the retail value, the appraised value is $100,000. The max you're going to loan is $70,000. And let's say, worst case scenario, the borrower, something happened, there was some health problems, the borrower couldn't come through on the loan. Well, you're in a position, you've got 30% equity in that property to where you could actually fire sale it. Okay, so it's worth 100, you just give it away at 85, you pay your sales commissions, you got some closing costs in there, and you're still protected at your 70% or $70,000 loan you've made. So that's the reason why you want to really keep the loan to value as low as possible. And we'll go over a scenario here in a little bit to kind of give you that example as to how that works. Loan amounts. This is really contingent upon you. What your tolerances are, what you have in the ability in your IRA to lend, whether that be $25,000, $50,000, $200,000, $500,000. That's really up to you as to how you drive that. Property types. We talked about that a moment ago, and how critical and important property types are within your loan program. And you might specify exactly, I only lend on single-family homes, 1 to 4 units. Or maybe even single-family units with one family. Not even want to lend on duplexes or triplexes and so forth. So it's completely up to you. And again, the NOO, which is what that means is non-owner occupied property. Because of the restrictive laws with lending to a regular retail borrower, someone who's going to purchase the property and live in it, are held to much different standards and disclosure requirements from the federal government, HUD and CFPB. So in the cases that the loans we're making, it's best practice to do it only on non-owner occupied property to borrowers who are buying property to rehab, fix, flip, or hold as a long-term hold, okay, and be non-owner occupied property. So also insurance. You want to make sure that you are going to obtain a lender's title policy to ensure that the title on the property is clear. There's no issues, and the title company is going to be your very trusted third party that will walk you through and make sure that there's no title issues on that. Because when you go to sell, when the borrower goes to sell our property, we want to make sure there's no issues, okay? And the title insurance protects you for any unforeseen issues that may come and arise from that transaction. And also insurance on the property. One of the things that we do is require the borrower to obtain insurance on property insurance on the project while it's in your name, in the borrower's name, with your loan attached to it. Because the house burns down, no insurance, there's a big problem. And we want to make sure that that's covered, all right? And in some instances, insurance companies have a hard time, writing policies for non-owner occupied properties. Properties are in disrepair. So sometimes a borrower would need to obtain what they call builder's risk insurance, okay, which indicates to the insurance company this is a much higher risk property. Let's say we might have electrical issues or some other potential hazard or something like that where the insurance may be more expensive, but that's a borrower's cost. But you want to ensure the absolute insurity that the fact that that property is insured. So let's talk about loan purpose. Obviously, it's to be. You could loan on a refinance. You could absolutely do a refinance, but in most cases, we're looking at doing a purchase transaction where the borrower, our real estate investor, is looking to us or to you as a self-directed IRA holder to borrow money to purchase a property, to then borrow funds as well to rehab the property and then sell it. So that would be the loan purpose. And the rate would really be contingent upon the risk factors of the project, okay? And some of it is driven by market. What you'll find, and depending on the marketplace, you'll typically find rates, a fixed rate of returns during the term, anywhere from 8 to 15%. So it really depends. So if you've got a borrower that is a good credit risk, that has experience, has reserves, then you may not be able to charge 15%. So it really kind of is driven on a few factors within the project, which is the borrower, credit, the property itself, the location. That's really what would be driving that rate factor. And typically during the period, you could structure the repayment however you wish. You could do interest only, which would be the easiest thing to do. You could factor principal and interest, but because it's just a short-term loan, it's probably not worth the hassle to structure it that way. It's really difficult, and probably, in fact, most borrowers won't expect to be paying principal and interest during the term. Some you might find that would even ask, hey, could I borrow this at no interest payments, or no payments rather? There would be interest, but that they may negotiate with you that they defer payments. And of course, it's certainly up to you. One thing to consider in that fact is I don't typically, as a lender, I typically would advise against that because it takes away some of the pressure off the borrower. So, for example, let's say we agreed to do an 18-month term, okay? The borrower takes them 3 months to rehab it, and here they are in month 6, and the property hasn't turned over yet, hasn't sold. Well, there's really no pressure on the borrower to get this off the books because he's not making a payment. It's just accruing interest, which in my opinion creates more risk to you as the self-directed loan holder. So be very careful as to offering to no payments to a borrower. And a little further deeper on that, what kind of borrower are we going to lend to? And it's the best practice to lend to a established company rather than a sole proprietor. So you would lend to an LLC, an S corp, something other than an individual or a sole proprietorship. Okay. And typically, you're looking at closing within a short period of time. These transactions happen pretty quickly. That would, depending on your marketplace, depending on the borrower, depending on the situation, we've seen them close as fast as 4 days, 3 days. If you've got title work in place, you've got a valid appraisal. If the deal makes sense, you've got a great borrower, easily producing documents, they can happen pretty quickly. But I would expect between 10 and 30 days from the time, let's say, you talk to a borrower, they come to you with a proposal, here's the project, and getting title insurance and so forth. I would say 10 days, 7 to 10 days on the minimum. And lastly, within your sample loan program to consider would be more about the borrower, okay? And then we've touched on this a little bit, but how is it exactly that we're determining, say, their experience, okay, their income, their assets, their credit? So what you want to see as a best business practice is pricing your loan and determining your loan approval based on their experience, okay? Have they done any transactions before? Do they own any real estate? Have they dealt with contractors before? Have they been successful if they have? Just because someone hasn't done a transaction doesn't mean they would be a good risk. They wouldn't be a good risk. That doesn't mean that. So, but if they have, say, real estate experience, let's say they're, a realtor, or say they're a contractor, or they have some general knowledge about the business. Income. So when we're looking at borrowers, some of them have full-time jobs, and which could be a positive or negative. Whether they are don't have the time, they got a full-time job, they got family or kids. It gives them less time to possibly really keep on track of that project. But at the same time, if they've got a full-time job, they do have income, which will help carry that loan through the process and to closing, and have something to fall back on if something goes awry. Also within the assets, within the approval, you want to be looking at determining what kind of assets you want to see. And typically what we're looking at and would prefer to see is at least 6 months in reserves and cash to come to closing with to close on the project. because the last thing you want to do is put yourself in a position where you've looked at the borrower's financials and they have no money. So they're relying completely on the loan that's being provided to do all the rehab, pay their contractors, pay up front for materials. So those are the things you want to be looking at within determining the borrower itself. So those are some sample loan program ideas to consider. It's certainly up to you as to where those could drive and what's acceptable, what's not acceptable. So,
okay, Kevin, before we go to the test cases, okay, we did have a number of questions pop up. If we
sure.
can maybe get to those. One of them first for something I can answer says, if you want to rehab and flip a property bought by your IRA, would your rehab company be able to do that? The answer is no, because your rehab company is a prohibited and disqualified entity from basically transacting with your IRA account. So if you're going to have your IRA buy a property to flip it, your IRA has to pay a third party to do that. Another question that came up said, how does the Dodd-Frank law affect lending from my IRA? Kevin, I'll let you expound upon this, but my understanding with Dodd-Frank is if you're lending money from your IRA to a fellow investor, then the Dodd-Frank rules do not apply. It's only when you're lending money to an end user, someone who's actually going to occupy the house, that Dodd-Frank does apply, and the IRA is included in either of those scenarios. So the IRA does not have a special exemption. If Dodd-Frank's going to apply, then it's going to apply to, if it's to an investor, it doesn't apply. If it's to an end user, it does. Is that on point?
Correct. Scott and I had touched on that just a minute ago about if you look on that the borrower piece, that's exactly why we loan to companies, not individuals.
Okay.
Someone who's will not be occupying the property.
Right, because that was the question. So two people actually said, is it bad or risky to lend? Why is it bad or risky to lend to an individual as opposed to an LLC or corporation?
And that's why, because the Dodd-Frank rules, CFPB, HUD rules apply to those who are borrowing money to occupy the property as their principal residence. And when it's non-owner occupied and it's making a loan to a company, those Dodd-Frank rules do not apply.
But if you knew an individual was going to be an investor, is there any reason why a corporation or LLC would be riskier than an individual? I understand the Dodd-Frank component to it, but if it was just a flat, if it's investor either way, is there a difference why you'd rather lend to a corporation than an individual?
Well, that would be more of a legal question for your closing attorney. There is a reason, Scott, and to the listener, there is a reason, and it has to do probably with the foreclosure process and how easy it is in the worst case scenario to secure your property or secure your loan.
Okay. Another question: so, would you typically have the borrower pay for the lender's title insurance?
Yeah, the borrower would be paying all of the closing costs, and this is a negotiable thing here, but in most cases, the borrower would be paying all the closing costs to close the loan.
Okay, another question here on getting a good question. Why do flippers, or I guess why do rehabbers with cash equity, have equity in a property, typically borrow money from a lender at a higher rate? Like, I guess the question being, if you can get a loan from a bank, if you have equity in the property, you get a loan at a bank for 4 or 5%. Why do the rehabbers typically borrow money from lenders at higher rates?
Well, they do that for a couple of reasons. First, because of speed. Most banks don't work off of speed and transaction, so they're willing to pay a slightly higher interest rate, even though they could probably go to the local bank and get a loan. The other thing is some banks aren't even willing to make a loan on a project or a house that needs repair. So if the house needs major, you had a hoarder living in the house, and those are great buys, by the way. But if the property may not be something the bank will even lend on. So there's a couple reasons. It's speed, and it's that the bank may not even be able to do so.
Getting back to the question on the LLC or corporation, even if you're going to lend money to a corporation, you're still getting a personal guarantee, though, correct? That's someone questioned.
Correct. And again, that may be driven by the borrower. It may, if you've got a sophisticated borrower, they're going to ask, and I would too, to have a non-recourse loan, meaning, and let me back up here, a recourse versus non-recourse loan. You may have heard that. A recourse loan means that in the event that this property goes to foreclosure and there's a deficiency, there's a difference of money that I owe you after what the foreclosure property sold at sale, I could come after you in a recourse loan for that deficiency. A non-recourse loan means I'm not personally guaranteeing anything on this loan. It's the property that's securing your loan.
A couple more questions. I'll let you get back. I want to make sure we wrap up here soon. But one of the questions says, if you're not a majority owner of the rehab company, I guess that was getting back to if your IRA owns property and you're rehabbing it and you want to hire your rehab company, if you're personally not a majority owner, there's still other ways that could be considered prohibited. It generally is advisable to find third parties. If you're not a majority owner, you may be able to skirt the rules to some extent, but there's definitely some other considerations. I'd encourage that individual to give us a call. Call us in advance and we can walk them through that. One more question, I'll let you get back to it, Kevin, was someone has some money, about $21,000 or so. Are there any non-purchase transactions that I can lend to, like rehab-only transactional or bridge lending?
Well, and that might be a question you could answer, Scott, but,
okay.
Whether you mingle, is this a question like mingling funds with another investor?
I'm not sure. I mean, there's not much more written than that, but if you wanted to mingle, you certainly could partner your IRA funds with other people to make those loans, or if you find someone who only needs $20,000 to complete a rehab, certainly you could lend money to that. So the answer, I think the questions are you definitely could put that money to use. It's just a matter of if you're involving other people or if you're finding a loan for that fits within what you have to lend. So Kevin, I'll let you get back to it. We have a few more minutes. I want to make sure we get through the rest of the presentation. We will be emailing the PowerPoint at the end. We will give everybody the PowerPoint by email as another question. So.
Okay, excellent. So let's wrap this up. This last section here is about a test case, and this is a property that's actually located in Snellville, just like a bedroom community right outside of Atlanta. The property was listed as $95,000 in foreclosure. It was a 4-bedroom, 3-bath, as you can see here. And what happened was the property final bid is at $105,000. The after repair value is $185,000. So let's take a look at the test case here. On the right-hand side, the box there, again, just laid out what I just had described. The total cost to rehab this property, which included repairs, carrying costs, and so forth, of $120,000 on this project. Again, the ARV, or after repair value, is $185,000, which means if you made a loan on this project, it would be at 65% loan to value, which, as we talked about earlier, our guideline is 70%. So this certainly is less than and puts you in a better risk position at 65%. And if you loaned at 70%, the loan amount would be $129,500. So let's say the borrower in this case, he has a little bit of experience, or she has a little experience, has done, say, 2 flips in the past 24 months with mixed results, meaning let's say their first transaction, the first flip they've ever done, they broke even. And the second, they did better and say they netted $25,000, $30,000. So that'd be mixed results. They've got a full-time job, they've got stable income, they've got a decent credit score at 630, and they've got a rental property that's free and clear, $65,000 value. So it's a smaller property. But what they are asking in this case is they want 100% financing. They want this loan to cover both the purchase and the $15,000 to cover the repairs and carrying costs, and they want no monthly payments. Well, that still seems like a good idea, but let's look at this in looking at the final scenario approval. So again, $120,000 loan amount, 65% loan to value, and in this case, we could loan them at 12%, give them a 6-month term, extend it for 3 months if necessary, depending on the market, depending on what it takes to get the property up to retail condition. And then we'll do an extension fee of 1.5%. And because they wanted 100% financing and they didn't want to make payments, this kind of goes to your question that came up a minute ago, Scott, of, hey, what if they only need like $30,000 for the rehab, and you could probably partner or joint venture with somebody. And in this case, okay, you want 100% financing and no monthly payments? All right, we'll do that. But we're going to joint venture. We're going to do share in the profits. So you could negotiate that with the borrower. Or if you came back and said, you know what, I'm really not comfortable, you have no skin in the game, so I'll do 90% of the purchase price. So if you went back to them and said, okay, 90% of, what was it, 105? So you come in with $10,500 as the borrower, as your skin in the game, and I'll do that loan at 12%, 6 months, and so forth. So you got to get creative, because every deal is not going to be cookie cutter. It's not going to fit always within the programs. It's not going to fit always within your loan underwriting guidelines that you set for yourself. But the biggest thing to remember is to, when you're making a private money loan in your real estate self-directed IRA, that you do it and you mitigate the risk. Transfer the risk away from you in every possible way. And that will set you up for success. And I certainly hope that today that I was able to give you a few tips and some ideas to think about. And if you would like to see our underwriting checklist that we use here at Street Lender, just send me a quick email at kevin@streetlender.com. And if you would like us to take a look at your loan program, we'd love to review that for you. And if you have any questions, feel free to reach out. And I appreciate your time today. And Scott, I'm going to put it back to you unless there's some other questions.
Yeah, Kevin, we actually did have another question come in. Said, can a real estate loan taken by an IRA have recourse against other IRA assets? This is talking about if your IRA is actually the borrower, can they have recourse against other assets other than the property against which the loan was taken? Again, IRA question, I'll take that one, Kevin. That's the answer is it can if you are pledging those other assets for that loan. If you are not, though, a non-recourse loan means simply that the bank only can come after the property that is securing the loan. So they would not be able to come after anything else in your IRA or you personally. So I hope I answered that question. Kevin, I had one other question. In the last test case, you mentioned it was a 6-month loan, basically, before the interest rate goes up. Could you increase? Could I have a loan term if greater than 12 months? If this is a situation maybe where someone might actually be renting the property as the owner. Let me speak a little bit on that. If I wanted to increase the length of the term.
Sure. If you as the lender wanted to increase the term.
Correct.
And the borrower was the exit strategy was to rent it.
Or flip it. I mean, I guess the question was, could I lend with a term greater than 12 months?
Absolutely. Absolutely. You could go as long as you wanted to. You can go 10 years. You can go 30 years if you wanted to. I don't think, Scott, that's best practice because if your exit strategy, and you came to me as, hey, I'm going to fix and flip this property, it's going to take me 6 months, then I'm going to give you 6 months. If you come and tell me it takes 12 months and it's a larger project, I might give you 12 months. I might give you 6 and give you 3-month extensions. So the answer is yes, you can give as long as the term as you want to. But remember, the longer term you provide, the more risk you're taking in your self-directed IRA, because there's a lot of things could happen to that property. And if a property is intended to be rehabbed and fixed and flipped in 6 months, if it takes 2 years to get it to the point of its retail buyer's going to find it, it's been sitting vacant for 1.5 years. So it's something to really consider that that property, securing your self-directed IRA and that private money loan, the longer term you give, the more risk you're taking.
Okay, well, Kevin, we're kind of up on time. I want to thank you again for coming in. Hope everybody will actually go back a slide there. If you need Kevin's information when you get hold of him, especially to get that underwriting checklist or maybe have kind of your loan program reviewed, get in touch with Kevin. He can give you some great information. We appreciate, Kevin, obviously, thank you again for coming on. and sharing some great information with the people who've attended today, and then obviously those who might watch the recording at a later date. Just to remind everyone, we have some more other upcoming webinars, seminars related to self-direction, whether it's the HSA webinar next Tuesday, or the live classes we're having on private lending and an IRA. We won't talk about as many things as Kevin talked about, which is great to have him on to talk about what to consider when you're making that loan and making sure you're making a smart loan within your IRA. But those seminars will talk about really what's involved with an IRA and how that's structured and how that process works. So if you have any other questions, I encourage you to reach out to Kevin, reach out to myself. My information's here on this last slide. Go to our website at advanceira.com. You'll always see all of the rest of the upcoming events, whether it's a networking event, seminars, webinars, etc., at our website. So Kevin, again, thank you very much for participating today.
Thank you, Scott. I appreciate it.
All right, and to everyone who listened, again, thanks for attending, and we look forward to having you on again. Thanks.